Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, May 28th, 2024. Hope everyone had a wonderful holiday weekend. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So, today's key macro events are green shoots globally, and anticipate that the combination of low growth expectations and trending positive economic surprises will continue to perpetuate the tactical outperformance of European equities over their U.S. counterparts. The AI theme has broadened out to the commodities asset class, and we believe that move has legs based on where we are in the positioning and business cycles. The prospect of faster than expected easing by the ECB sends conflicting signals from the perspective of global liquidity, with the net impact likely to be a modest drag. Transitioning to our 42 macro dashboard here. As always, we'll wrap up with a question from our community. This question reads, best assets for a global liquidity downturn. Says, hi, Darius, what are the best assets to invest in during a global U.S. liquidity downturn? A global U.S. liquidity downturn is essentially inflation, risk-off inflation from the perspective of our market regime nowcasting process. There's not a lot of places to hide when the market regime is risk-off inflation. The best places to hide are U.S. dollar, short-term rates, so short-term treasuries like T-bills, things of that nature, and then gold tends to hold up pretty well on a relative basis. Again, just on an absolute return perspective, from an absolute return perspective, there's just not a lot of places to hide. But from a relative return perspective, the key market risk that you're focused on in a risk-off inflation market regime, which is more likely to be going, which is the story of global liquidity cycle downturn regimes, that those regimes tend you tend to see duration risk as the key risk in those regimes. And so long-term fixed income securities and assets that are heavily correlated to long-term fixed income securities tend to underperform. So you tend to see things like even high yield credit, which obviously has a lot of credit risk, but does not necessarily have the duration risk, can outperform things like investment grade credit, which has a lot more duration risk. So it's a really interesting sort of regime to risk manage, because again, there's a lack of availability of assets that provide positive absolute returns on an ex-ante basis, but it's a fun regime to play factor rotations in from the perspective of our institutional asset manager friends. So it's a good question. We did a big deep dive on the global liquidity cycle in Saturdays Around the Horn. So for those who may have missed that, definitely check that out and the implications therein. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, May 28th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.